All right, so I've been out for most of this week, kind of battling a little bout of pneumonia myself here. So that's why I haven't done the videos on Monday and Wednesday. So hopefully be back to a normal routine here next week. But even in my absence, the stock market just continues to rise unabated here in the near term. So I'm going to break down, what it looks like this week versus last Friday, whether or not I can pretty much put you on repeat from last Friday with the same expectations in the short term or not, and how that translates, what this move over the past so many weeks has done to translate, to impact our expectations going forward. There's been tweeted that this was the stock market rally that no one saw coming, and the reality is you all did, because we've been talking about these expectations for bullishness in the year end throughout most of this fall volatility that we've had, and so now we're realizing that those expectations, and I'm going to break down how they change, if they change, now that we're starting to see the beginnings of this rally, and what to expect this month and next month and into the early part of next year. So, and then our trade idea is going to be a stock that we've been bearish on in the past, that we're going to turn things around and look for bullish trade opportunities. So let's go ahead and get started. Today is Friday, November the 8th, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. You can see we finished the week strongly. We have the strong bullish intermediate posture here with the intermediate line well up above 80 in the upper reversal zone. It's above 95, so above 96. So it's it's about as strong of a bullish intermediate posture as you can possibly get. Market sentiment's rising. It's at 74 now. It's rising. That's the pattern. I mean, you have dark green shading and a green line, and rising market sentiment. That's generally about as bullish as you can get. Now we are well up above the 30-day moving average, as you'll see here in a minute. So that might limit any upside in terms of, like, are we going to get this far of a move in that short of a time frame again? We've essentially gone up from October the 8th to today's close 7%. We've gone up about 7%. Let's see. Let me snap these, and then we'll get it for sure. So from the close there up to today's close, is that right? Let me make sure I'm on the close. Up to today's close. So yeah, about a 7% return there, 6.93% in the matter of 24 trading sessions, or 32 total trading days. So almost 5 weeks. That's an annualized return, as you can see up there at the top, of 79% annualized return. So, when I say that our upside might be limited, that's what I'm talking about. Are we going to get another 7% return in the next 24 days? I'm going to bank on the idea that no. And the answer to that would be no. Now, again, you look at over here and you say, okay, well, what was our return from that close up to, say, right here? That was 23 trading sessions in 30 days. We had a 9% return there. Okay, well, that's a pretty decent return. Well, from that period on up through the next 18 days or 17 days, we went up 1%, an annualized return of 17. So we still went up, but not 9%. Not an annualized return of 80 to 100%. So you get the idea that that's kind of we're not going to get another 20-day run like this going forward. But it doesn't mean that we're going to fall like this anytime soon, like we did in last July or early August. More than likely, we'll pull back towards that moving average, and I've got the Fibonacci lines drawn on the current near-term run. So any pullback we might get that brings the near-term line eventually below 50 will probably bring us down to around 30.50 as of right now, because that's the way that the lines are drawn. Any more significant pullback than that which might bring the intermediate line briefly below 80. I don't think we're going to drop below 50 anytime soon on the green line. But if there's any more significant pullback where the near-term line pulls back a little bit more and people start going crazy again about, oh, we're going to head into recession, because that's what we do, right? We alternate between going crazy to the upside and going crazy to the downside, even though they're just swings. But if we do end up swinging back down to the downside a little bit more than just that 30-50 level, and we pull back down towards 30-20, which would still be, tons of support in that area, be a very good buying opportunity for those who actually do use those dips for buying opportunities and not for, pounding the table about why the market should be bearish and this is the beginning of the end and so on and so forth. If you end up using then I think we'll get some good opportunities there. But that will be a scenario where probably the green line drops below 80 and we get light pink shading. I don't even think that we would, the moving average might be up there by then, but I don't even know if we'd get a yellow line by then. It'd probably just be a brief intermediate turn, and then we'd be back up to what I expect would be, an intermediate run through the end of the year into the beginning of next year. So that's what I'm seeing on the S&P. You can see the Russell 2000 is kind of caught up finally. Still hasn't produced a 52-week high point yet. We're getting closer. Its near-term line has finally pulled down. In fact, it's pulled down a few times here in the past week, 2 weeks, whereas the S&P hasn't yet. Excuse me. So it's not as overextended in the near term, but it's not going to be able to maintain itself without the S&P. So as you see, the Russell is forming some short-term weakness. Expect the S&P now to finally bring that into next week. Again, it doesn't mean that we have to drop sharply. I'm not looking for that kind of short-term weakness or this kind of short-term weakness. I'm just looking for anything that will bring the blue line below 50. And in this case, will most likely bring the S&P. Now, again, if we don't pull back to 30-40 and we pull back to, say, 30-70, 30-75, and that's all we get, and then we run up higher, that's not going to be enough, right? That's taking too shallow of an exhale. Deep inhales, shallow exhale, deep inhale, shallow exhale. That generally leads to uncomfortable pullbacks. So it would be the best for all market bulls, because that's the trend of the market right now. It would be best for for the market to maintain this trend and be healthy in maintaining this trend to at least pull back to 30-50. And then that will set us up for another near-term run of 7 to 12 days. I'm going to venture to guess we probably will start to gravitate more towards 7, because we've had such a big long run this go around that you'll probably follow that up with a few shorter than normal runs, until we get back to kind of a normal inhale, exhale type impulse move retracement pattern on a near-term basis. Okay, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of our screen. Hit that red subscribe button that pops out. It's also down below the video. Subscribing to our channel will notify you when these videos are posted on YouTube. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you like the video. And number two, you want us to do it again on Monday. So it's our survey. It's basically our way of getting feedback from you, like a survey feedback. So if you like the video and you like us to do it again, then tell us. With one click down below, you can do right now while you're watching. Also, while you're down there, what did you get out of the video today? We also like to hear anything that you learn or anything that you think other people should be watching the video for. New people come all the time and check out these videos, and the first thing they do is they go to the comment section and see what people say about it. So let them know down there why they should check it out and make this part of their routine. Join or subscribe to our Market Scholars website. There's a link that's popping out in the top right corner of your screen. Click on that link. That will subscribe you to our site for free. You can participate in our Market Outlook forums. Also get access to our market commentary section in our blog. Follow me on Twitter for more content in between these videos from day to day, and then join our Facebook group that we've created for Market Outlook viewers. All right, if you're watching this video on our blog post, you see there's lots of other things here that you can check out. Our Market Outlook live trade review videos are linked right here. You can click on this image. It takes you to that page. I've already put on today's Market Outlook trade idea in that particular video, that live video. We also review all of our old Market Outlook trades all the way to the close, and sometimes I close them, and I close them in these videos, and I talk to you about what I'm looking for and why and how I'm managing these trades. You can see all old Market Outlook video posts in the archive section up here. Our calendar of upcoming classes. I'm feeling a little under the weather, so I'm not going to be doing the Q&A session tomorrow, but next week's classes are also linked there. Our monthly plus subscribers, which is linked right above the video, you get access to all of our 8 trading rooms that we have each week, week in and week out. So that's over 8 hours of content you get access to. You also get access to those videos whenever I do the Market Outlook. I do these daily trade review videos too. Down below, you can see we ask you to engage with us on social media with our Market Outlook tweets and Facebook posts. The more you engage, the more Twitter and Facebook will promote our content at the top of your timeline, so you always get the stuff that we're putting out there. They will show you the stuff you engage with the most, so we try to make it easy for you to engage with our content. You just hit this little heart, it opens up that window, you can like it there, or click on this image and you can like it, like today's Market Outlook Facebook post. All right, let's get back to our charts, and let's look at this long-term chart. Great bullish candle again. This is now week number 4. You can see on this intermediate run where we have bullish weekly Heikin-Ashi candles. We closed above last week's high point. That's bull. I mean, you can't be more bullish than that. In fact, if you look now, the Russell 2000, we have been looking for the Russell. It came just shy of closing above that week's high point right there at 1599.40. We ended up closing at 1597.95. So just barely coming up short, but closing above these highs and the previous week, that's a pretty decent reversal pattern. It's going to be even more bullish when you get above 1618. Remember, we are trading right now, the Russell's trading at 1598. So, the more it trades next week, we're at 1597 right now. The open next week is going to be right at this midpoint of this candle. So, barring any significant pullback to the open, we'll start, the close next week will be around 1600. And depending upon where the Russell spends most of next week, we could be getting closer and closer to 1618. The close, remember, on the Heikin-Ashi candle includes the open, high, low, and close of the actual Russell's values for that week. So, but we do have the golden cross now for the second week. It's looking a lot better for the Russells catching up. You can see the NASDAQ composite obviously now. If it was close here at this 83.39 and we close at 83.25, well, now we've busted through. So there's the close that we had last week on the S&P has been accomplished this week on the NASDAQ. And then, of course, same thing with the Dow. The Dow got its breakout week this week with a close up above there. So really good bullish breakout patterns across the board on the Heikin-Ashi. Means that we can get, again, this run, which is 4 weeks long now, typically lasts 4 to 13. So if we head towards the 13 end of things, we might have another 9 weeks of bullish Heikin-Ashi candles. Now, again, do I think we'll get 9 weeks of the kind of move we got this last 4 weeks? Probably not, because we've had such a great move in such a short amount of time. But, are we going to trend to the upside over the next 9 weeks? Potentially. It could very well be the case. I would expect, I don't know if it's going to be exactly 9, but I would expect that we'll have a pretty decent run that will get to around that expected time frame of 3 months as we head into the end of the year, which is seasonally a bullish time of year anyway, regardless of the type of market we have going into it, which in this particular case, going into it, we're set up for a bullish market regardless of the seasonality. So now you put those two things together and we have very good odds of a good run into over this next couple of months. Let's take a look at the 3 green arrow chart. Three green arrows, nice and bullish, right? And then you look at the two-line version of that, and you can see we're losing some bullish momentum because the bullish momentum is very high. But losing bullish momentum doesn't mean that we have to go bearish, right? It just means that we might flirt with below the 8-day moving average and start to move towards a 17. But I don't even see that as, again, unless we get that kind of bigger pullback, I don't even see that as a possibility. I see us more flirting with the 8-day throughout most of next week and maybe dipping our toe a little below the 8-day before turning around, setting up that new low and making a run back up and maintaining the bullish momentum by the orange line. See, the orange line can stay bullish. If I were to zoom out on this chart and show you a longer time frame, that orange line can stay up here for a while, right? As you just kind of ride a trend higher. You can see it gets up to these levels and just kind of goes sideways for a while up here. In this case, we got up and pulled back a little, but then stayed, so we tested the 30 a couple of times, but stayed bullish for the time frame I expect that we'll get in this type of run. Maybe not to that magnitude, but that's like the time frame I expect us to see here. All right, so now let's take a look at the intraday charts. And you can see for the most part, we were pretty sideways all week. A little gap up yesterday, filling in the gap. After filling in this gap on Wednesday, essentially Tuesday and Wednesday, and then closing up near the highs of the week here. But as I mentioned last week, the low points really moved up over the course of this week. To this 295.5 level, and again after today, that's going to come off, and tomorrow or Monday after Monday, that's going to come off, and this will be the low for about a week before we start to rise again. So we have now moved back up to where we're almost at that 15-point mark. So again, that's 5% of the high. That's going to be the stretch of the rubber band, and so it doesn't mean we can't go up, because of course anything can happen. It just means it limits that upside move potential in terms of how big and how much in such a short amount of time. The bigger the stretch is. So, but the stretch, we don't have to go down, obviously, for the stretch to pull in, and that's because the short term, this low point can start to move up, and as it moves up over the next couple of weeks, you can see it will only take a couple of weeks to get to 300. And then that will now open up a lot of room to the upside, depending upon how we perform in the next couple of weeks. So if we kind of meander around between 306 and 312 over the next couple of weeks, that's going to be the reason why, because our upside will be limited and we'll have some volatility. And then as things shrink up, then we'll have more room for it to make more of a move. From wherever the low, maybe 306 might be that low point that we make the room move off of, and eventually make our way up towards 320 or whatever. By the time the next near-term run, really significant near-term, like I said, the next couple of near-term runs, because of how long this one has been, I don't expect to be very big. But then after we kind of get a good exhale out, then we can inhale and have a good 7 to 12 day near-term run, and that's kind of how I'm going to expect us to watch for this to play out over the next couple of weeks here. If we take a look at the range today and the volume, you can see the volume at 49 million and the range here at just under 2 points. If I were to put this on the scale, so 49 million, just under 2 points, you can see 2 points is the low end of the ATR over the past year. So that shows how low the ranges are, well below 1%. We are entrenched below 1% on this ATR, relative ATR mark here. And then you can see the volume is also extremely low. It's down to its lowest end. The average is for the past 52 weeks. And it can stay when it gets really low, it can stay really low for a long time. That brings us up to the volatility index, which last week had closed at extremes for the first time. Well, this week, even more at an extreme. So again, that might lead to some volatility, again, volatility that may get this back up to 90%, that may get this closer to 15. I'm not talking about sharp drops here in the market. I'm just talking about a little bit more volatility than what we've seen in the last couple of weeks, especially as you see the range for the month, which you see last month's range was a whole 9.25 points of volatility. We're probably not going to touch 20 again in November, so we're not going to get another 9-point range. But even right now our range is 1.39 points, and if we're going to get say a 5-point range, which is still well below the average, then we're not going to go another 4 points lower. We're not going to hit 8. It'd be another 3+ points higher where we touch 15 or 16. That's what's going to get us a 5 point, 3.5, 4 point, 5 point, which would be very low as it is. But that's how we would produce that type of range. So that's why I talk about, when is that going to happen? Well, it could very well happen in the next week or two. And in fact, I very much expect it to. So to summarize, the markets are strongly bullish, and I expect they'll continue to be strongly bullish for probably the next couple of months into the end of the year. But I do think that we're pretty strongly bullish in the near term too, and have been for the past week or two. So this is nothing new. I sound like a broken record every Friday. But I do even more so than last week now expect another probably week, or because we've been so bullish in the near term for so long. The deeper the inhale, the deeper the short-term exhale will be. So I expect we'll probably have another week or two of some volatility, not mind-blowing volatility to say the least, but enough to bring us back a little in price towards retracement levels, to bring the volatility up a little bit towards 15, towards the 90% mark on the VIX to VXV. These are not, the markets aren't going to go crazy. At least I don't expect they will. But this kind of like day after day halt, run to the upside, probably run out of some juice here over the next little bit. And whatever the headlines might be, the catalyst of that short-term volatility, I don't know whether it's going to be the trade war or whatever. But that's kind of what I expect, and we'll get a nice little exhale and back to a normal inhale again after that. So what do you think? Do you agree with that assessment? Do you disagree? Now's your chance to vote. You can click that link right there, popping out top right corner of your screen. Opens up a poll, then hit either agree or disagree. If you click disagree, comment down below on why. What are you seeing differently? Whether you're more bearish or more bullish, either way, it's okay. Whatever is driving your opinion, share that. And that's what, everybody's got an opinion. But what's more valuable is what's driving. What chart are you looking at? What indicator is telling you that, whatever, either that you're more bullish or more bearish than what we just came up with? Share that in the comment section down below. All right, now let's take a look at what's driving the price action here. And you can see this. Look at the difference here. This is the last 3 months. Before that, you can see this is the last 6 months. And in fact, if you looked at it year to date here, that we've had a pretty strong run in equities year to date and crude oil. But you see how, like, you got risk appetite here on the year to date. You had risk appetite on the 3 months. But in between, you had a pretty decent run on safe haven asset classes. And now that run is pulling back. There's VNQ, there's TLT, there's GLD. They still have pretty decent 6-month returns. Still better than stocks, despite this little rally we've had here. But this gap that we had before the rally started that we're now making up, that's the unwind. That's the safety trade unwind. And you can see there's still room left to go as we transition down to the 3-month. There's still room for these to go. To unwind, and I think that's driving a lot of this type of price action that we're seeing. The safety trade, the risk appetite trade is gaining strength. International stocks, crude oil, small caps still haven't quite joined to the extent you would like them to, but they're still getting decent returns. It's not like they're lagging behind significantly. If you look at the 12 grid of these different asset classes, let me pull that up here. You can see the dark green shading and the green lines on emerging markets, on developed markets, on U.S. stocks. but dark pink shading and red lines on bonds and foreign bonds and gold and real estate. So the safety trade, even preferred stocks, is really rolling over, and yields are starting to move up higher. Crude oil, you can see, is just starting to turn around. It's got room to move up higher. High yield is pretty flat but holding up versus the losses you're seeing. And you can see the dollar is even rebounded off of some significant struggles it's had. If I were to, here, let's take a look at the daily chart for the dollar index. This has been a really good week for the dollar. We finished last week with an oversold cluster. And I mentioned I wasn't too bought into this. We're at support. I wasn't too crazy about the dollar really selling off here. And this week has been a huge move up to the upside. And this is what it looks like on the Heikin Ashi candles. You can't really see with these lines here. Let me get to to a different study set. Well, here, if I just get rid of these, well, let me zoom in. That's what I'll do. That makes it a little easier to see. So let me go to like a 1 year chart. There we go. So there's what this week's candle looks like. And what does that tell you? That is a transition candle, if you've ever seen one. Coming off of a bearish move, you get big upper and lower shadows, small body. The body next week will be right in the midpoint of this body. So it's going to start right here. And you can see we're already trading at 98, with 98.40, which is up here. So we're going to, again, barring what kind of break, any kind of gap to the downside, a significant gap to the downside, when the market opens over the weekend, we're going to start next week with a pretty bullish candle. And again, depending upon what the weekly reversal is going to look like, we can have multiple weeks now that the support is holding in this area and we reverse. So we have opportunity for the dollar to continue to be bullish. Now, what impact will that have? That will have an impact on these international stocks. They might not continue to outperform to the extent. They'll still go up. If equities and risk appetite goes up, international equities are going to go up too. They just will start to lag U.S. stocks, and you might see small caps start to do a little bit better again if the dollar maintains this reversal. Otherwise, if we kind of peak here, and we roll back over, this is the beginning. We have light green shading and a yellow line. That's a reversal pattern, a bearish reversal pattern. So if this turns into a bearish move next week, then look for international stocks to continue to outpace, especially emerging markets, and to continue to make their runs, because as I mentioned before, and I'll bring it back up again. If you look at all of these. Let's look at the 12 grid for all the biggest economies in the world and the ETFs that track the stocks, those biggest stocks in those economies. This is a broad-based rally. This is about as broad-based of a rally as you could possibly get. Only Brazil's got a little pullback here, but that's there's the opposite, like a light pink shading and yellow line. That's a 3 red arrow buy signal there. So this is a pretty broad rally that we're getting in Asia, in Europe. In emerging markets all across the board. From a sector standpoint, look at these cyclical areas. This is a 3-month chart, mind you, but look at the cyclical areas really taking off. Financials, industrials, technology, right? 3 big cyclical stalwarts here. Apple being the main driver of that cap-weighted XLK there. But if you look at the 6-month chart, and you can see that it was just a week ago that utilities and real estate and staples were the 3 biggest winners. And now other things are catching up and closing the gap, and energy has still got quite a room to go before it catches up the gap. So the same theme that applied from the asset class standpoint applies to the sector standpoint, where the safety trade that was so overbought because people were so pricing in a recession. It would have been the most priced in recession in history had we actually fallen into a recession. Now that we're not, they're unwinding that trade, and that's a really bullish thing for the rest of these asset class or sectors that were oversold. As you can see, financials and industrials are down here when those asset classes were up at the top, and technology was outpacing, doing okay, and it's really taken off. So Now you can see energy also. So like I said before, go back to the 3 month. Your biggest losers have been some of your biggest winners over the past little bit. And if I were to go back to October the 8th, where this near-term run started here, up until now, then you can see here there's energies included in that area now, along with materials and energy both, and healthcare making a nice little run today. Pretty much everything participating. You just don't have communication services, which is Facebook, Netflix, Google, and then communications discretionary, which in this case XLY being cap weighted is pretty much Amazon. The lagging performances in those stocks has kept those ETFs lagging behind a little bit, but still bullish over the course of that period. Okay, and so for our trade idea of the day, I want to go into this healthcare sector, which had a nice little pop. It's been out kind of matching the market up and down. Briefly was the best performing sector off of that near-term low point. Has been up and down over the last couple of days. But one stock, AbbVie, has been a stock we've been doing really, really well in from an old market outlook trade idea from both Brandon and I, both back-to-back market outlook videos, in fact, for different reasons too. So that just shows what a great opportunity we had in AbbVie over the last so many months since we did those videos. But another stock in that sector that has been showing some bullishness, where we had been bearish before on this stock, is United Healthcare, and it's made a nice good run. It's got that strong bullish posture. In fact, if you look at it on its Bollinger Band standpoint, then you can see that it's been pushing through a lot of volume to the point where it's gotten up above its point of control and it's flirting with the top of its value area. So you've got very strong support below current levels. That's pretty late. So even though we made a big run, you would say, well, we could fall all the way back down there so fast because we moved up so much. The reality is no, because we've had all that volume that we pushed through. Now, as we pull back, that's going to be where your support is, at this 247 area, where that point of control is. So any pullback's going to be pretty minimal, despite the big rally we've had, because of all the volume that you're able to push through in that time. So, but it also, the problem is to the upside from a directional standpoint. If you'd say, hey, now we can be really bullish, well, it's already been pretty bullish, and you've got some resistance here at 266.5. At that volume node up above the value area, that once you clear that, then you've got some good trending that this stock can do with minimal resistance above. So with that being said, when you got that kind of technical setup where you're pretty bullish, if you look all across these bullish patterns, like here's the long-term chart, and you can see you're pretty close to a golden cross on here. And again, like I said, get above there, and like I said, you've got a good trending opportunity because of, you'll just barely be getting a golden crossover at that point. Then you look at its, we saw the 3 green arrows. You see that you're well above the 8-day moving average. You got strong momentum. You look at its Ichimoku cloud chart, and you can see you're well up above the cloud, riding the green line higher, strong trend, almost to the point of getting a very strong trend. Which would be the 80 mark and the 5 mark here on trend quality. And then finally, you look at the directional movement index for UNH, and you can see the positive line is well above 25, above 30, and the negative index is below the 20 mark. So that's your bullish pattern, bullish trending pattern. So you've got this high probability bullish setup. You're a little limited in the short term in the directional opportunity, but you got very strong support below us. Well, that's about as how you would set up a short vertical spread opportunity, a high probability option trade opportunity, where I sell this 250, buy the 240. You want to try to get 232, which is where we got in during the live trade review video. And then because this is a $10 wide spread, our normal position sizes for these videos is $1,000 risk. So that would put us here. One spread would put us right around 700. So we can't do any more than one. We can't do 1.5. We can't do 2, because even though I will most likely never take that big of a loss, you still have to position size for the possibility of it, knowing that the most I'll ever lose, hopefully, is $228. That's what I want to keep my loss limited to, which would be down if we were to fall back below this kind of 245 mark. That's how much, knowing that we got some very strong support at 250. If we're breaking 250, then I'll probably just take that loss at $228. Otherwise, we have a high probability setup that we're most likely going to take for the $750 that we'll employ. You can see that I already have employed $768 that I have employed. That I have a pretty good high probability to make $232 with that $700. And then, like I said, even though I can't get to a full position size here, I can still use that capital somewhere else on another trade and continue to try to get. So it's a small reward than what you've been getting in some of our other directional trade ideas we've done, but the market's kind of transitioning from the potential for good directional moves, because we've realized that potential over the last 30 days, to now a really high probability bullish setup that's a little overextended in the short term. So that leads you from transitioning from more directional trades to less directional trades, more high probability trades, where we just kind of slow the flow a little bit and just start racking up the high probability gains, kind of managing our risk in case there is any kind of more significant pullback than what we expect to get. All right, well, that wraps us up for today. Again, you've heard from me now. Now, when I hear from you, use that link that's popping out in the top right corner of your screen. Excuse me. And then let us know what you think. Open up any new thread. Any questions or comments you have about anything I talked about or anything I didn't talk about that pertains to this topic. Let's keep this conversation going in our Market Outlook forum with our community. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment down below. And comment down below. And remember to follow me on Twitter for more content in between the videos, and join our community, our Facebook group that we've created. Again, thanks for watching. Have a great rest of your weekend, everybody. We'll see you all next time.